One more, everybody. One more central bank to go, and then we're done. We're done. Good morning, everybody. Morning, gents.
Morning. What do you mean? We're done? We're done forever?
Done forever. We're not doing central banks anymore. Had enough of them.
I think there's two, right? Good morning.
Yeah, we got. Well, I wasn't counting Turkey.
Yeah, we can stuff a few turkeys as well.
Yeah.
How are you?
Do you like
Ryan?
turkey, Kay? Still, do you like turkey? We know you don't like lamb. Do you like turkey?
I do like turkey. Yes.
There you go. Probably the driest meat on the face of the planet. Yeah, that's probably why you like it. Like a bit of dry humour, don't you?
Yeah. All good. How are you, Kay? You good?
Yeah, all good, man. All good.
Good stuff. All right, we're almost there.
We're almost there. Let's get through it. Come on. It's not hard work, really. We laugh and joke, but it's all good fun. We enjoy doing it. But there is a whole ton of comments to get through, so we shall start there. Not seeing much out of Asia today, so I'll let you guys throw that in if you see anything. Not that I've seen much at all. Right, Brexit stuff then. We'll kick off with that. The Northern Ireland Protocol thing that was going through yesterday passed 515 to 29, so went through with flying colours. Here's a headline for you. The Bank of England says it warned US regulators over the SVB risks before its collapse. So for once, the Bank of England getting in front of something, according to them.
Wow.
Yeah, wow, indeed. You know, they couldn't see the pension stuff coming up and kicking them in the face, but they saw something going on in the US. So anyway, they're claiming a win there. The SNB, they raised 50 pips as expected today, did a bit of a brush over in terms of monetary policy versus financial stability, saying that they're ready to intervene in currency markets as usual. They don't rule out further interest rate rises and have been selling foreign FX over the past few months. Jordan was out with a few comments saying they're raising rates to counter the renewed increase in inflationary pressure. Further rate rises cannot be ruled out to ensure price stability. Will sell Forex in the future and also remain willing to buy to counter excessive appreciation pressure on the franc. So playing both sides of the market still, not manipulating whatsoever, of course. Norges went their 25 as expected, taking rates to 3%, and they say the bank rate will be raised further in May. Now sees the key rate at 3.18% in Q2 2023. Any particular comments you dug out of those, Kay?
No,
the S&P Norges?
No, I was expecting them to. Okay, we could say that another rate hike in May is a bit more than what other central banks may be doing right now, but then they're still in the middle of the pack. I was perhaps expecting some stronger wording on the weak Norwegian kroner, but no, I haven't seen anything that really stood out. Norwegian kroner strengthened just a little bit on the statement, but then no, I haven't really seen anything. They say like if everything goes according to plan, they expect another rate hike in May, but there is considerable uncertainty. So no, I haven't seen much to stick our teeth in on the Norges Bank.
Cool.
The S&P, yeah, I mean. What shall I say? Faithful to themselves. We are playing both sides of the medal. They're still in catch-up mode, right? Because we know they have a meeting only once a quarter. So there was some sort of doubt surrounding the 50 BPs on the back of this Credit Suisse story, but they didn't spend more than one paragraph on the whole thing and then brush it under the table again. And they're definitely still what in the same mode that they started months and months ago. Is that as they said that they had been selling FX in the past months. they want to fight inflation with the currency. So for the trading side of it, just wanted to add, I'm still long Euro Swiss, and because I think we still may see some outflows due to the Credit Suisse UBS story, but S&P seems to be determined enough not to let Swiss franc devalue from here, which is completely different than what they did for many years before. So I'm more going to range trade this than really thinking we may see a move up to well above parity. Let's put it that way. I thought there was a real chance for this to especially as well with the euro strength, to go at least test 1.003 again on the Euro Swiss, but I'm not sure we're even going to get it. I think the next few days or the next week will tell us enough. And if it's going nowhere, I'm just going to call it an adventure and taking a few pips out of it, and that'll be good enough.
Yeah, I know you were short into this one as well, weren't you? Up at 80s, I think it was.
No, I'm long. I bought it the other day. Average around 99.40.
Oh, so that was. Oh, sorry. I thought you went short this morning just before the meeting. That was a closeout, was it?
I'm just I'm managing my longs actually, but it's. I think if there would have been panic, and it still could come. You know, those outflows can still come. I think that the Credit Suisse, the shareholders, bondholders are still trying to see some of the money back. If not, I still think there may be some outflows, but it looks as if S&P is really going to keep it very tight, this one.
Yeah, definitely. I jumped into a small long down here as well, just on the reaction. You know, the market, euro had been strong, as we know. We knew what the S&P was going to do, so this move to me was a fade, so I jumped in a bit as well. I've got most of it away, got my stop at break even, so like you say, we'll see where it goes from here, but it's not looking like it wants to go back to those highs just yet.
No, it's no. I thought there would have been already a little bit more stress, so as I said, I'm just managing it. If it goes back through 99, I think I'm gone. I mean, right now, as the people know in the room, I'm always actively trading my positions around. So the average is pretty cool, but no, if it goes back through 99, I'm gone, mate.
I think at the moment this one's just moving on the back of the euro side more than the Swiss side, coming off a bit now. Anyway, but we'll dig into the price moves in greater detail over the next few minutes. We'll move on to the ECB. ECB's Lane says the banking crisis may turn out to be a non-event and be one factor among many, or have a macro impact, but that's a tail scenario. He uses the buzzword as well. If the baseline holds up, absolutely, there's more to do. ECB's Ren making the case that everything's a-okay in the Eurozone by saying the Euro area bank buffers are double those of the debt crisis. So plenty of bullets in the armory. ECB's Wunsch says have been dissecting bank sector data and figures are not showing any problems. The core is more sticky than headline inflation, must focus on both headline and core inflation. Without the 50 pips hike, markets would have worried. He's quite correct on that. If markets stabilise, we may have more to do on rates. ECB's Ren was out further after that, saying that the market terminal rate expectations are somewhat lower than their expected terminal. So the market apparently underpricing where the ECB are going to have to go. So hawkish from Rem. Says the terminal rate is a volatile concept, and the ECB must focus first on price stability, then financial stability. ECB's Visco says need to be very prudent with monetary policy. Credit growth has stopped in Europe. Says the important thing is avoiding a credit crunch. This was something that is falling into what Powell said last night as well. ECB's Pancetta, as we like to call him, says banks will pass on rates more compared with in the past. I can tell you one thing in the UK, we are not getting, savers are definitely not getting the full rate hikes that we've been seeing, keeping margins for savers very suppressed.
What do you actually get for a relatively simple deposit in a bank these days?
1 pip over fuck all, mate.
I was looking at I'm asking because I was looking at the US size of the city and B of A and all that, and the deposit rates are something like 0.5% or even less than that, and I'm like, rates are 5%. It cannot be, but yes, it is.
There's loads of deals coming out where you can get 4.5%, 5%, but it's on limited amount. So like the first £2,000, and then you get the rate after. So unless you want to open up 200 accounts, it really is
you can always get a free pen or pencil when you go to a bank and you play. So I mean,
you find one that's offering a free pen these days. You find one that's offering a free pen. You'd be good luck enough to find a branch.
I had one from Metro Bank. I had one from Barclays. I mean, wherever I went, I always told not stealing actually. They're there for the using, right? So I always took one, because we get nothing at all on the account. So that at least saves me some ink for when I do my post-its.
Exactly. And you can use COVID rules. If you've touched a pen, you don't want to give anyone else the lurgy, so you might as well take that pen home with you.
Absolutely.
Right. Yes, we don't endorse stealing pens from bank branches, people.
No, but they are there. Right? They are there, free to use, and
that's why we haven't got savings rates, because people keep pinching all the pens, and it's costing them billions a year. So stop pinching pens. We might get a better rate, Kate. Anyway, Bundesbank's Nagel says further hikes needed in coming meetings if inflation develops as projected. The job is not yet done, said the ECB must be bold and decisive. Rate hikes are a journey, and a journey isn't over. So very hawkish comments from the German, as to be expected from those guys. The Bank of Canada had their summary of the March decision, the deliberations there, and basically in the summary, no one made mention of considering a hike at the last meeting, and they agreed to emphasise the conditionality of the rate pause, so taking away any hawkish slant there from their deliberations. Powell's arch enemy, Elizabeth Warren and co, are unveiling legislation to create an independent inspector general at the Fed. She's going to get a clause right into Powell over this SVB stuff, considering the Fed oversight of the bank leading up to the problems. As far as shifting the deadwood over there, the FDIC have delayed the bidding deadline for the Silicon Valley Bank until tomorrow. They've had several attempts, or tried several times, to offload, as I say, this deadwood, and they are coming up unsuccessful at the moment. Not sure why. Either they're setting too high a price for it, or no one wants to touch the stinking bag of poo with a barge pole. But they keep trying and trying. So over to the event last night and Powell. So the Fed went the 25 as expected. They changed language in the statement. They now say some additional policy firming may be appropriate, whereas before it was saying that ongoing increases are likely appropriate. So a bit of a dial down there on that. One of the key sentences in the statement was that the US banking system is sound and resilient. Recent developments are likely to result in tighter credit conditions for households and businesses, and to weigh on economic activity, hiring, and inflation. The extent of these effects is uncertain. That was a bit of a catch-all line in there, because it covers everything. If the economy starts turning softer, they can use the excuse it was this banking problem. If it doesn't, they can say that the banking problem has been solved by their measures, and they can continue, and basically it's a win-win for them any which way it turns out. But it really has covered all sorts of bases in terms of what may happen to the economy. Then Fed was out, Powell was out with his usual stuff in the presser, and one of the funny things was he said that, talking about the bank stuff, he says all depositor savings are safe, and yet literally as he finished that line, not minutes after, Yellen was speaking as well, and she said she is not considering insuring all uninsured bank deposits. So a bit of let's say left hand, right hand going on there, i.e. one not knowing what the other one's doing, because opposing comments from that, which has taken up a bit of press talk this morning. Further to the banking stuff, Powell said that isolated banking problems, if left unaddressed, can threaten the banking system, and the Fed will use all the tools needed. Policymakers generally expect subdued growth to continue. Almost everyone on the FOMC sees risks on growth as weighted to the downside. We expect growth risks to come in into better balance over time. He said that they considered a pause on rates, but that a hike was supported by a strong consensus, so they could have paused. The need for further hikes will be based on actual and expected effects of credit tightening in particular. So now we've all got to look at credit numbers coming out the US. Rate cuts in 2023 are not our baseline expectations. If we need to raise rates higher than expected, we will. The recent liquidity provision that increased the balance sheet size was not intended to alter the stance of monetary policy. There were a few wonky people thinking that that jump in the balance sheet, how they came to this conclusion, I don't know, was QE, i.e. they stopped QT and they injected money. That wasn't the case. That was just that banking funding program that they put in place. They got the liquidity and slapped it on the balance sheet. So after all that, it's been taken as a fairly dovish Fed. He didn't quite do the same as the ECB in saying there's no risks from the banking stuff, although he has made the determination that there's a difference between monetary policy and financial stability policy, but he has put it all under the same umbrella in terms of what they do for rates, because, as I said, that first sentence where they are saying that the fallout from this could impact credit conditions and the economy. So overall, it's been dovish. Forecasts have already started to be cut. Bank of America cut their terminal rate by 25 pips to the 5 to 5.25% mark. UBS now see no hike in June where they saw one before. They've also lowered their terminal rate to 5 to 5.25 from 5.25 to 5.5. So what do you make of it, guys? Was it massively dovish, or was it just acknowledging the problems they got?
For me, especially the pressure, it had a little bit for both sides. So for me, it's a matter of interpretation at the moment, and that's why I think we're seeing the market kind of being a little bit hesitant. So it looks like the final rate, how do you call it? The terminal rate is very close now. I think we probably have maybe one more hike unless inflation starts doing something stupid. But the whole point is, how long do they stay there? And this is what the market mover yesterday was. I don't think there was any big surprise. Yes, Powell maybe was slightly on the dovish side. I wouldn't call him very dovish yesterday, but he did talk a lot about the market pricing cuts and in 2023. And by the way, the market's still pricing cuts. We are pricing just under another, let's say, half a hike in May, and then we're pricing 3 cuts by year end, which, the Fed are telling us that this is not going to happen, at least now. This is what they're telling us. So there was something for both sides. The way I've read it, is that I thought it was a dovish, my interpretation is dovish, simply because when you're on a hiking cycle and the market's pricing cuts, what do you do first? If you want to stop and you want to pivot eventually, you first talk about where the terminal rate is, right? And then you start talking about what happens afterwards. So, it's the indication now is that the terminal rate is very close. And but they did say that Powell did say that the cuts are really out of the question for now. I think they're going to come into the question, a couple of months from now, maybe, especially if the economy starts worsening more. But for now, we are getting to this point where now I think we're at the end, and I think the pivot is coming closer than they are telling us. Hence, the market pricing it. Do I think the market's a bit aggressive in pricing? 325 cuts by year end? Probably, yeah. But I think the market is not completely out of its mind, and my interpretation of yesterday was that it was a dovish hike, and I am going to trade it that way. So I'm actually going to go later today and update for all the subscribers all my macro views, and I'm going to be getting a little bit bearish dollar. And I'm already a little bit bearish dollar, and I'll be definitely looking to sell into any dollar rallies that we get.
Yeah, thanks, mate. As you can see there from the dots on this side, the left-hand side is last night's updated dots. On the other side is the ones from the last meeting last year. You can see it's the 2024 stuff hasn't really changed an awful lot. It's still pretty widespread. I would have thought maybe some of these lower numbers would have shifted up a bit higher, but it's not really changed at all. Even the 2023 dots have not changed, that much. In fact, the most hawkish has even come down a dot or level. So the market's looked at that as well. Not much change. There hasn't been a reinforcing of that. We were expecting that ceiling to go higher. And they said that Powell said it might have gone higher had we not had this banking stuff. But I think the big difference made, and if you compare it to the ECB, is that they didn't say, okay, once we're over this hump, we're back on the hike path. It's all very conditional. Kay, what do you make of it all?
Yeah, he went more data dependent than he was already in the last meeting. I would argue, though, that the dots are showing the extra 25 BPs to come, right? So if you look, the latest one is the left-hand side, right?
Yeah.
The concentration is a bit bigger above the 5%, yeah? And we got an extra dot there closer to 6%. But no, and as you say, I mean, it's a dovish hike for what we could have expected. But the thing is, most of us, or most of the market, was actually expecting such an outcome. So the market actually got what it wanted. And as you were saying earlier, that famous Yellen line in the middle of his press conference, I think did more damage to the dollar than it provided for the second wind in the dollar sell-off. And that's where also, because the equity markets were not really panicking anywhere, but when she came out with that, all of a sudden the thing started to turn south, right? So to me, it's not a pivot yet. They're just leaving everything open now on the table, and I'm going to trade it that way. I'm also a bit bearish dollars. I've been, well, the week before or so I was long cable. Then yesterday and I sold those out perhaps a bit too early. But then yesterday I flipped into euro dollar longs. I'm still actually relatively positive on the euro as such as well, because the ECB is now really catching up, right? In whether it be in actions or even their words. So I think euro dollar may have a little more legs than some other stuff. But yeah, I mean, to me, it is a dovish hike this time, but I would not call it a pivot yet. And there's something interesting, because if the market prices, and you have to go up to you have to go back to the 10-year or so, right? If the market really starts to price cuts, we have seen the housing market, the last, what is it, 2 numbers, Ryan, starting to pick up a little bit.
Yeah.
If you look at if this market really starts to price in more cuts further down the curve, it could make the mortgage rates a bit cheaper and underpin the housing market, which in turn is going to come back to the Fed then afterwards, and they are going to say, well, if the jobs market holds up and the housing market is now holding up again, we're starting to hike again. But that will be for the next move. I think in the meantime, I agree. I think the dollar is for the time being at least a sell on rallies. Although tomorrow could be another interesting day coming up with the PMI. Tomorrow it's PMI day, right? So tomorrow could be another funky day. And again, I'm still not like of the idea, or personally at least, where you go like, all right, I'm selling dollars and I'm buying them back come end of July. You know, I mean, I'm still very active in managing whatever I have on the books, but the bias is for a slightly lower dollar right now. Right?
Yeah, you can see that in yesterday's NBA, the rate came down 6.48%. You know, quite a steep dip on that. And yeah, you know, we'll have to see. Like you say, there's been a bit of divergence in the data, as we've been mentioning this week. So you need to see what strings are being pulled which way. If housing is strong, as Kay said, if jobs are still strong, that suggests the consumer will remain strong. And we're back in soft landing, no landing territory again.
But I think we are in now a period where we are going to see divergence in some data. Some are going to come in better, other ones less, and it could be a bit of a funny market to trade, and that's why I also think it's still safer to have a bit of a bias, but not getting too much married to one position, you know.
Exactly. And the case in point was that Philly Fed services number. You know, in the last round of ISM and PMIs, manufacturing was soft, services was very strong. This week we've seen Empire and Philly manufacturing both weak, and the Philly services very weak as well. So, you know, they are small regional numbers, but they're the first numbers we got to go on this month. And if it follows that pattern and we see services in the PMIs dipping now, that's going to throw a few cats among the pigeons, I think, because it's going to suggest that it's going to be a bit of a wobbly way forward rather than any real trends developing. But that's what will lead us up to the next round of central banks meetings in a couple of months or whatever. But for now, we can forget about them until the Bank of England, of course, which is coming up. So do you guys think that anything that's happened at the other central banks is going to lead the BOE to change its tone? I'm still thinking that inflation number this week is going to, yesterday, is going to maybe send them out a bit more hawkish than usual in the message.
Yeah, that threw some spattering in the works, right? Because the plan was for one more dovish 25 BPs hike and done. I don't know. There may be a bit of change of tone there, and all of a sudden, the Bank of England coming out a little more hawkish than the rest. And we have to say, barring some numbers, also like other numbers, but the main numbers are holding up pretty okay, right, in the UK right now. We didn't really see big catastrophic numbers, right? Only the credit and the plastic credit card numbers were not great, but the rest I don't recall really having seen extremely bad data on the sterling. But the market doesn't trade it that way. The market is trading sterling still on the defensive, testifying the euro sterling, testifying the cable having trouble to keep it above 123 right now. I don't know. I think the surprise trade today will be more hawkish Bank of England.
Yeah, I agree with that, and I think I didn't get anywhere close to my plan for cable over the Fed and the inflation, so I'm a bit more neutral about trading that one. But I think euro sterling could be the one, because despite what the Bank of England may do, even if they do talk slightly hawkish, it's going to be at the dovish end of hawkishness, if you like. So I think any gain you get in a quid, particularly against euro sterling, I think that might get picked up. Any decent dip there might get picked up because the euro is still very strong, and that's going to outweigh anything that the pound does right now. So that's what I'm going to be looking at for the BOE. If maybe get a dip to sub 80s again, 88s, down to the 88, 60, 70 area. Let's show it on the chart, which we got a little tap down to yesterday. So that area is showing up once again. Yeah, I might look to take a little something on that if we get a decent dip in that one, if the euro remains strong elsewhere. Stel, you got any thoughts for the BOE?
Yeah, I would agree with Cayman. I think the inflation print really has complicated things. And let's face it, the inflation is still probably the number one issue with many people, and the inflation in the UK, as you guys know very well, is rampant, right? So what can the Bank of England do? Well, the only tool they have is rates, and they're definitely going to do 25. I think there is a good chance now that they're going to indicate that, look, if inflation doesn't start dropping, because it's rising again, right? If it doesn't start dropping, they're going to have to keep going. So I fear that the Bank of England may be more hawkish than expected. Having said that, the Bank of England is always as dovish as they can be, which is annoying. But with that inflation print, I really don't see how they can be dovish in any way. We are expecting a 6-3 split, aren't we?
Yeah.
Which I don't know even if we'll get that. We do have two doves who are probably gonna remain dissenting, but I don't know if we're gonna get a third one. So
Man, right?
Yeah.
Man is probably going to vote for 50, no?
Yeah. That's true.
So
Actually.
I mean, that's just a guess,
Yeah, I think there's going to be a the chances are there's going to be a hawkish surprise. Having said that, the only weapon that the central banks have is rates, and you're going to make goods and services stop increasing at such a rapid pace by strangling the economy and causing job losses. It's a rock and a hard place, right? But that's all they can do. So yeah, my view is. Sorry?
That's what they get paid the big bucks for.
Big bucks for, yeah, Bailey, big man. No, so my view is this. I think a bigger risk of a hawkish surprise.
Yeah, I think so. The vote numbers are going to be important because Ryan, I think. Yeah, hello.
Yeah. I have a question for you. This Brexit thing, we know it's been going on for ages now. But if Sunak would have been voted against the Brexit thing, do you think that Bank of England is looking at Brexit right now, or is it just secondary and we'll see what happens if it has an impact on the economy or not?
I think it's secondary because this portion is all the Northern Ireland stuff. They're more worried about what's moving to Frankfurt or Paris. What's happening with financials, that side of things. They always pay lip service, the Brexit stuff, but this thing is contained with Northern Ireland. It's more politics than anything else.
Yeah, I agree, but it's just a question, because I see when we look at stuff, we see a lot of people trying to ask questions about it, and oh, Brexit this and Brexit that, and sterling should go down and whatever. But it's perhaps just an interesting fact to just mention it for a minute and just confirming that it's not really on a first line topic on a Bank of England agenda.
Yeah, definitely. Yeah, and as we said with this Northern Ireland stuff, it hasn't been really impactful for the pound. Plus, you can never trust it. You get a headline saying that, yeah, great, we've got a deal, and it still takes 3 months before they actually put pen to paper and rubber stamp it.
Mine at 3 months.
Yeah, well, that's just 3 months just for this one. And yes, it is still ongoing because the vote yesterday was only on that, what they call in the Stormont break part of it. So it wasn't even the full vote on the rest of it. One day it'll be over when we're older and grayer. But back to the BOE, and I think the inflation maybe puts the risk towards this vote number coming in at 7.7 to 2 again. But that'll be a minor thing. I think the 25's done and dusted. I don't think they'll go anything like a 50 just on this one pickup number and inflation. But yes, how the minutes show who voted for what, i.e. what type of hike increase, could be important as well. If there are some who have shifted back to 50s, that'll be a hawkish slant there as well. So it's going to be what the announcement is, and then digging into the minutes and the statement and everything else to see what's changed. And obviously, we'll be doing that here in the ForexAnalytix room as normal. Trading wise, as I say, I've touched on the euro sterling. I'm not really inclined to touch the pound, maybe unless something pushes it up to that 124 area, and then potentially I'll be looking at that just for a pure tech trade rather than anything else. This big zone up to 124, 124 and a half could be a good range top to have a look at over that one. For me, euro dollar, I didn't actually do anything new over the Fed yesterday. It was more just sitting back and knocking pieces off my euro dollar long. It's run into trouble up at some half decent resistance. This 109, call it 109.40, is an age old level. I'm not sure, it might be a bit messy to see it all the way back. Where are we? Just around here. So you can see, if you get your microscope out, it's been a level that has been in play for several times. Most recently, after we had that move, well, before and after that move over the 110, you can see we had resistance before the 110 move, and we had resistance after that move failed. So that's why that's sitting on my chart. We've also got this longer term trend line that we're knocking up against, which comes in from down here, 2016 through 2020. So we're hitting the underside of that again. So there's a bit of tech around this, call it 109.20, 109.40 area. That's keeping things contained for now. This was my big zone up here, the 108.30.70. Obviously, big event like the FOMC, it just carved through it. At the moment, it's holding near the top of it, around that 108.70 on this dip here. I would expect if we get through there to maybe see something coming in around 108.30. But I think we're going to see a situation again where we need to know where we close the week. If we close the week above 109, for me, that sets us up for a move to the 110. If we don't, if we close below, then maybe we set up a bit of a higher range, maybe 109s down to 107s. That will become the new 105, 107s. Because I don't see any reason why we rocket massively from here on out, unless the Fed, are really done with hikes, and then the market really goes into pricing cut mode, all while the ECB get over the banking hump and continue hiking. If that's the case, I expect euro across the board to remain well bid for a while longer. Again, it still may not mean we're going up another 1,000 pips from here, just on the ECB continuing to hike, but we should see the euro remain well bid on dips as well. Kay, I know you're looking at some of the euro crosses as well. Do you see the same situation there? The euro too is in BTFD mode.
Euro in the buy the dips mode, but a couple of crosses, Euro Aussie, Euro Canada, they're showing. I'm not saying exhaustion, but they are we are into interesting levels. I don't know if Stel wanted to show something today. Otherwise, I can do a quick overview.
I can, because I'm not going to be here tomorrow. So I
Okay.
will,
I mean,
I will do it today.
You
Yeah.
know, he's thinking off, folks. God, bloody hell.
the
It's a,
stage
sc-
is yours, Stelios.
it's a school holiday tomorrow, and I promised my girls I'm going to take them out to lunch and all that. So we haven't done that
Stage
in
is yours.
months. So
You don't take us out for lunch.
I know. All right. So let me just pull that up a little bit. So the Fed obviously yesterday, the big event, and as I said before, we got a little bit for both sides. Although I interpret it as being dovish, I've heard a lot of people making hawkish interpretations, and the main question remains: do they cut this year as priced by the market? The way the Fed is talking to us now, they're saying no. But obviously, I don't trust the Fed, and they can change very, very quickly what they're telling us. So yields. Let's face it, yields are driving many of the markets, and we saw good support. We had been talking about this area of interest around 335 to 340 ish. We tested it on a few daily occasions, marginally went to new lows intraday and then bounced back. So yields have found support. And for me, for yields to drop below, that means that either inflation is dropping very quickly in the US, so the next print, or B, we get the banking crisis flares up and we get more trouble. And that will obviously mean flight to safety, and bonds are one of the first places where people go to. So bonds are supported, yields are supported, sorry. So that brings some stability to markets. As a result, equity markets are also trading pretty well. I have to repeat, I think they're trading in a very resilient manner over the last year, very controlled and gradual move lower. Yes, we're 20% or so lower from the highs, but just under 20% actually. But still, this is not a sign of panic. And I have this little area here drawn out. We're almost there. If we get towards 39.30, I think it's a place where I'm going to look to do some short-term trades. I don't usually do them, but the equity markets, have to say it and stress it, they feel short. They feel squeezy. Every dip gets bought recently, and I fear that the path of least resistance is to go higher. So I think that I want to be buying dips, and I think we're close to the first level that I'm looking at, and I wouldn't be surprised if we get towards 4,200 in the next move. Obviously, this has risks, and the main risk is if the market starts taking out the cuts from 2023. If we start pricing those out, that means we're pricing rates to be higher for the rest of the year, and as a result, maybe the curve further out goes a bit higher in yields, and that will push equities lower. But for the moment, given what we know right now, I think stocks are buy on dip. In exactly the opposite way is what I feel about the dollar, and these two are correlated. Usually they're inversely correlated, so dollar sells off, stocks rally. I think the dollar should be sold on rallies. The Dixie, if we manage to get anywhere near this this line, which coincides with the 50 DMA, so anywhere near 103.5 would be a lovely place to short, and we can get reasons for a dollar rally. Like Kay, I think, said, we have PMIs tomorrow, and we're going to be getting more and more data. And if the Fed, Fed speakers continue to be hawkish regarding the rate cuts priced into this year, I think there's a very good chance that we might get that little push up in the dollar, and I would love to sell that. The one I really want to sell is the dollar Norway. I missed that. I was waiting for 11 or close to 11. We got to 11.86. So unfortunately, I missed that. But any rallies towards this, 10.70, 10.75, I'm going to definitely look at. And obviously, dollar MEX is another one that I really like to sell. I've said this many times. Very nice carry. even with the Fed hiking more, the carry is there, and I like that. I also want to be buying dips in the euro dollar. So any dip towards 107.4, previous high here. There's a little bit. It seems to be an area of interest. So we also have the DMA. You know, it's an area of interest. So anywhere just below maybe 107.3, I think is something I'm going to look at. But we're not there yet. You know, with all these things that I'm talking about, we're not there yet. But you know, I don't mind waiting. So otherwise, currency-wise, not much for me. I am opposite to you guys regarding the euro pound. I know you guys are looking to buy dips. I'll be looking to sell rallies into the 90s, but I guess you can have both, right? You can have a dip and then rally, you know, a couple of 100 pips. That's not bad. So I'm going to be looking to sell proper rallies in the euro pound if we get them. The euro has been very strong recently, and given the apparent central bank divergence, this could continue. And I would love to see a rally into the 90s to start shorting, but obviously not yet.
Stelios,
yeah. Yes.
Could you give us just a 10 minutes heads up so we can take profit before you start to flash the things?
Don't worry, I'm always early, So when I do sell, you know, it's going another 30, 40, 50 pips before it. Anyway, so metals, again, you know, we've talked about metals. This was a really nice impulsive move. And from the 1800s, if you go to a 4-hour, it looks a lot better. And, you know, it's a nice impulsive move, nice little consolidation. Didn't even get, let's have a look actually how far it got. Didn't even get, wow, almost touched the 38.2. So yeah, okay, it got to 38.2. By the way, I should have seen that. That was a nice little bottom here on the 38.2. Anyway, but bottom line, metals are still trading well. Gold is outperforming silver today, but silver has been doing pretty well considering. And, you know, this level, there's a fib here at 23. It's a nice big round number as well. Few lows on the back here. 23 is the first proper level that we need to pass. But then really it is this 24 and change. When, not if, when that goes, I think that's the beginning of the next big move. And look at this. This is a, albeit lengthy, but very orderly correction, some kind of, you know, long bull flag. I know it's quite lengthy here, but still it's a very, very impulsive move higher. Correction. And if you think about what's happening with rates all these past 12 months or so, my God, you know, they have traded very well. Gold has traded really well. If you think that during this period here, we've had massive tightening, I mean, you know, very strong tightening at very fast pace, yields rising, all that, and still we're pretty much, you know, within touching distance of the all-time highs. So metals have done very well. I'm looking to add to my silver longs. I'm well over $1.50 now in the money also or so. And I'm going to be looking to add either on a break of this 24 and change, or if we actually have to look at the downside. Haven't looked at the downside in a while, but probably if we get, I don't know. I don't want to say something now on the fly. I'm going to have a look at the levels and probably post it in the chat room. But overall, metals doing well. The gold silver ratio has a big decision to make here. Look at that, 50 DMA, 200 DMA, both converging. There's a fib here as well. I mean, if we break below, or when we break below 85 or so, it's not that far now. This, I think, is going to be a very big technical sign that we're going higher in prices, because when the ratio goes down, more often than not, the price is going up. So this is something I'm looking at. Cryptos, we always look at cryptos. Yes, we've had a really nice rally. Bitcoin is now hesitating on this 23 0.6 fib. Also this area down here on the way down, we did slow down quite a bit here. So big hurdle to overcome. But if we do get a rally in risk, which I think we will, theoretically this should also follow. So a move towards 35K wouldn't be out of the question, and a similar story in Ethereum. Ethereum is heading into a little bit more of a resistance here, but Ethereum is a Bitcoin on drugs, so it's probably going to outperform on the way up. Oil is an interesting one. I read so many reports that the market's still relatively tight, and there's a big risk of OPEC cuts if prices keep going lower. I have a bad, difficult time in the short term seeing oil rallying. The global situation, it just doesn't inspire confidence, right? I mean, oil is very sensitive to economic growth and the whole global environment. Of course, it's controlled. The supply is controlled, so anything we say can be undone within 1 day's OPEC decisions. But the way I see it, we've broken down from this triangle. We're coming back, maybe try to retest, I don't know, but I want to be a seller of oil on rallies in the short term. In the medium term, I think inflation on its own is gonna make oil prices grind higher as we go. So yeah, oil a very tricky one, and it has very, very big weekly swings. So I would be very cautious trading that. Anyway, that's it from me, more or less.
Thanks,
I hope
mate.
I was helpful, and I'll pass it back to you.
Yeah, thank you, mate. Yeah, I agree with you on that oil trade in particular. The bounce so far looks pretty weak. Can't even get up to that broken level around the 72s. Though we are trying to hold above $70. So, early steps, I think, on that one. Kay, do you want to have your little perusal round, a quick one?
Shall I do it now, or shall we call it a day? And
we've gone through enough, I think. Let's have Kay do it tomorrow. What do you think?
Yeah, it's fine by me. Fine by me. Save the best.
I just wanted to add, if you go back onto the euro dollar for a sec, I have I have two decent levels, and they're coming back from zoom out if you can, on the coming back from a little bit higher as well. If you go back all the way down, all the way from okay. Never mind. There's a few levels I'm looking at in the 109.25.65, and as a matter of fact, 109.25 was the top this morning. So I think the 109.25.65 is going to be a big enough zone to keep an eye on today on the euro dollar on the top side. If we get renewed dollar weakness, I won't hold back from there we go. I won't hold back from taking profits up there. No, it's actually tighter, but I'll show it tomorrow. Exactly what I'm looking at in euro dollar.
Yeah, cool. Well, just under 40 minutes until the Bank of England. So that's our next focus. And tomorrow we shall chew through that one and see what the clowns have done over that meeting. We've had Turkey out. They've held rates at 8.5%. So unchanged there from the guys in Turkey and Erdonomics fighting inflation over there. Thank you very much to everybody. Have a great day off tomorrow, Stel. We shall cover everything here. Don't worry.
It's not a day off. I'm just not going to be on the flow show. I'll be around otherwise.
Okay. Right.
So
that's
you
cool.
are basically
off, mate.
the least important part of the day. No, I'm kidding, of course. I love you all. Love you.
Yeah, have a good one anyway. Thank you, everybody else. Thanks, viewers, for coming and watching us here. Thanks to Kay. We shall catch you all tomorrow.
Thanks, everybody.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.